right. Oh yeah, we got the new Zoom features of announcing that we are now recording as if everyone can't just look in the corner and notice that we're recording, but that's not good enough. Great to see you all. It is May 27th, and I'm really excited to have the session. We've got for many that are in the queue for the mastermind, this is their final opportunity to be part of these calls without membership in the mastermind. So obviously, most people on this are mastermind members, and we're excited to have you. I just recently got back from Columbia, Missouri, and Jefferson City, Missouri. We've got some family stuff going on there. Unfortunately, it's not positive, but we recently bought a property out there. So I was able to kind of double dip on this trip. And Eli, you'll be pleased to know it was a mobile home park. So I have added to the portfolio. I had a little bit of a pause there, and I've got all these buyers over the years or owners rather, over the years that I have accumulated, many of which I've got first right of refusal on their parks. And so every now and again, one comes up and I'm able to kind of swoop in there and get it. And we've got another one that we're eyeballing and another portfolio of 5 that we are eyeballing. So I still love the mobile home park game, and that's why we have Eli Weiner on. But before I give him a formal intro, I just wanted to remind everyone that we've got our happy hour event today at 4 o'clock. Larissa is going to be running that. So be thinking of your greatest health hack of the year. That's going to be a lot of fun. We're definitely excited to have you. This will be the final Lifestyle Investor Series event as is for non-mastermind members. So check out lifestyleinvestor.com/mastermind if interested. As far as open deals, if you have not filled out your forms for Entourage Effect Capital, please do that. I think we only have, Hans, you probably know, I think it's only like 5 or 7 people that haven't filled out that form, but we need to know that info as we're issuing this SPV. And that thing we should probably finalize, hopefully. Well, it's likely going to be next week, I would imagine. Maybe tomorrow, probably next week. Data miner, for those of you that were on the call last week, that one, once it sells out, it sells out. So that's just an offering of $750,000. So that'll be gone sooner than later. Tradeful, most people have wired in. I think there might be a few stragglers, and we're waiting to get countersigned docs on those. So that will be happening here soon. Next week, we are going to have sovereign distressed real estate. They're doing a fund that we can kind of peek under the hood at, and then we'll double dip with HPI Hotel Opportunity Fund. So a couple of different unique looks into some real estate asset classes that could be interesting and could be lucrative. So I'm digging in, and I want you to dig in as well. And I want us as a brain trust to be kind of figuring out what we think of that deal. So the one next week I have done less of a deep dive into. The one today I've done a lot of a deep dive into over a couple of years. So a few things. John Rulin's podcast just came out today, so check that out. We got a few in the hopper here for next week. I think I'm going to do a double release next week, so there might be 2 coming out. So be on the lookout for that. Masterclass is getting a lot of great feedback, so be sure to check that out. And our next mastermind event will be June 10th, and we'll be doing a core values exercise and event with Darius Mirshahzadeh. We're also going to do some networking as a group. So this one's going to be a lot more interactive, and I'm really looking forward to that. So we've got a handful of new members that I'm excited for you to meet that will be on. And then as just a friendly reminder for these calls, let's post questions in the chat. We'll let Eli kind of go at his speed through, and he can answer questions in the chat if he wants to in real time. He can wait till he's done, whatever suits him best. I'm going to give him access to be able to present. But I appreciate anyone who, if you can have your video on, it's more interactive. I like that. At the end, if it's too hard to type out your question, you can certainly ask it. So we'll do Q&A at the end. And then when we're done with that, when Eli hops off, we'll do another round of just kind of like figuring what people think, questions, concerns, comments, etc. Now, this is going to be followed up by another event, another investment opportunity in a totally separate asset class, a totally separate style of investment in a group called Festival Pass. And this is just a friend that I was connected to via one of my private clients, actually. And he's doing some really cool things. And I'm excited. He lives here in Austin, and I'm excited for him to share his opportunity as well. But without further delay, Eli Weiner's on, and we are excited to have him on. He's got a hard stop at the end of the hour, and we're thrilled to have you. So BoaVida is a fund. It's an investment group. They've been investing in mobile home parks for a period of time. In fact, their stats are pretty impressive. They are some of the largest acquirers of mobile home parks of anyone in the space. They're really, to me, just a handful of big players. They're one of the big players. Eli has a lot of experience in the space. They bought up a ton. I'll let him go through all the specifics, but I believe it's 138 properties, more than 15,000 spaces. So it's pretty darn comprehensive. He's the eighth largest owner operator. So you guys will remember I had Frank Rolfe on my lifestyle investor podcast last week, and he's the fifth largest owner, and he's been in the business for, close to 30 years. So for Eli to have moved into the number 8 spot is really impressive. He's in 26 states. And I've had the opportunity to talk with Eli in the past about my portfolio, and I've called in and asked a ton of questions on this fund. I've compared the PPM to other PPMs that are out there, and so I want to showcase this because I think Eli does great work. The fund has a fantastic reputation of great returns to investors, and they obviously know what they're doing. And I believe they know what they're doing more so than several of the other funds that I'm in, that there are a couple other people on this call that are also in. So Eli, without further ado, give us the goods. We're so glad to have you.
Yeah, well, thank you. I'm very passionate about the mobile home and RV business, and I could talk for hours and hours about it, but that's neat that you guys are investing in real estate and in so many different asset classes and learning the business. And so I'm really looking forward to answering your guys' questions about there's the why are we in mobile home parks, and because I've asked myself that, several times, and I tell a lot of people that try to get me into other investments that the mobile home park business has totally messed that up for me. The predictability of being able to say, this is what it's worth today, and if I change these 5 things, that in 5 years, it's going to be worth this number. And 9 times out of 10, I'm wrong in a really good way. So, they always kind of exceed your expectations. But yeah, basically I'm 43 years old. We own and operate 138 mobile home and RV parks. We probably have about 150 million in deals under contract. We probably have another 150 million out in offers. Last 3 years, we've done a fund where I put my money in the fund, at least $2 million, and I invest side by side with all my investors. And we basically look at about 1,000 deals, and we try to see if we can find 20 deals that make sense. Every year it gets tougher and tougher. I think this year in particular, it's going to get what we're seeing is pretty crazy. The offers, we're stretching on some deals where we really love the market. And, we know that we're going to be thrilled to own that park 5 years, 10 years from now, but then we'll get outbid by $1 million. So we're seeing stuff like that, and we're definitely not getting caught up in it. So, and I think it's going to keep getting tougher and tougher as, 5, 6 years ago, the Carlyles and the Blackstones and a lot of big, guys that worked at Goldman Sachs raised $50 million funds. All those people were getting in the business, 5, 6, 7 years ago. And now it seems like everybody is chasing mobile home parks. So, um, you know, it's been pretty interesting. But basically, a little bit of background is, um, you know, my father started out in the timber business. My father has a well-rounded real estate background. I grew up in a real estate family, watching a lot of people build wealth in real estate and then lose a lot of money in real estate. My father was one of those guys that that fell in love with the 1031 exchange. Um, and so he'd solve problems, he'd increase the value, solve a bunch of problems, and then he would sell that asset and then go buy another asset with problems. And the 1031 exchange is just, you know, it's a good tool to keep in the toolbox when you need it. But people that use it as strategies tend to kind of get hurt, because they're selling at really great times, but then they're stuck buying at really good times. So we have a buy and hold strategy. But so basically, he got into the business to help sell some of his land. He was buying 10 homes at a time from manufactured home dealers, and then he realized that, wait, if I opened up a dealership, people coming onto the dealership, they didn't own land, so he could sell them a home with some of his land. And during that time, I always worked construction for him, but I was going to UC Davis and had an opportunity to sell some homes in a park in Davis. So I made a deal with him to sell an existing home that was in the park. I sold that fairly quickly by placing an ad in a thing called a newspaper, and you know, how much down, how much a month, and sold the home within probably 10 days. And then I was able to fill up that park, and actually dropped out of UC Davis and I moved to the Bay Area. I wasn't able to make a deal with my father, but I was able to start my own dealership selling homes in the Bay Area, where I was basically buying an old home in someone else's mobile home park for $40,000. That would give me the rights to the space. I'd take that home, throw it away, and then I'd buy a brand new home for $40,000 from the factory, spend $20,000 setting it up, and then I'd sell it for $150,000. And I'd just keep doing that. And that was a very kind of very profitable, but very high capital, and also there was no tax protection to doing that business. So I had the opportunity through one of our connections to buy a mobile home park up in Northern California. All those old homes I was throwing away, I would take up to that park, set them up. And back then I was seller financing those homes once they were all looking really good and remodeled. I was selling them for you know, 19,000 with 2,000 down at 14.5% interest. So I created my first mobile home note portfolio, about 150,000 in notes, earning 14.5%. But by doing that, I was able to triple the value of the park really fast and then refinance out. And back then I bought it for like 300,000, had a new value of 750, got a new loan at like 450, got the money out, and then went and did it again. I really didn't know what I was doing. I was good on the construction side and the sales side, but I didn't know the finance side. A few years after that, we actually refinanced that same park, got a $1.2 million loan when we kind of knew what we were doing. So you know, now we have several parks that we've I like to call the refinances harvesting. So we've harvested multiple parks multiple times. Last year we harvested a park for the third time in 15 years. And we never refinanced just for the sake of refinancing or loan notes due or anything like that. We refinanced to pull a bunch of money out. So, and that was the case again for the third time on that property. And also, when we do that, for example, we bought this park in Desert Hot Springs for 2.55, refinanced it within a couple of years, got the money out. A few years after, about 5-6 years after that, we got a $5 million loan, paid that down to 4.5, and then last year got a $7 million loan. So took $2.5 million out. Our payment, because the interest rate is $4,000 less a month, and because it's interest only. And that was based on a 65% loan to value. So that's kind of where these properties are always exceeding our expectations. So I kind of built a name with all the brokers. I'm very easy to work with, so I get a lot of deals. They also know me as, buying a lot of fixer-up properties, which that helped me for a little while, but also hurt me. So I kind of I want to make sure that they're bringing me all the big nice stuff too, because every once in a while we'll buy something that's like just great. There's very few things wrong with it. Repave the streets, do some tree trimming, and the rents are just, low, or it was just underpriced by $1 million. I can think at least 3 of those deals that I did last year, where there wasn't any heavy lift. But basically we, from refinancing that first park, buying another one, doing it again, 2007 came along. I actually bought a park from Frank Rolfe in Oklahoma, when he was shutting down his first partnership. Bought it for 1.5, and 5 years after that, I got a $2 million loan, and I actually 2 years, and then 7 years into it, I sold it for 4.5 million. I wish I never sold it, because I know that the guys that bought it, they're still doing great, but I wasn't growing. I didn't have the team to grow outside the Western states at the time. So it just made more sense to sell that and then 1031 into 2 California properties. But looking back now, it was cash flowing great, but it was a really good offer. And that's only one of 2 parks I've ever sold. But basically in 2007, 2008, I learned how to kind of raise money and syndicate properties, because if I didn't have a refinance, then I didn't have any money to buy it. So that's where I learned about, preferred returns and stuff like that. And then kind of moving on to 2017, I had an opportunity with an energy company, Flyers Energy, where to help them with 1031 exchanges. We bought 65 million, paid all cash in mobile home parks. And what happened was all of my money and all of our investors' money that we already, were working with, we were hitting all these stabilizations on all these parks we already owned. So what we ended up happening was our money was building up on the sidelines while I was helping Flyers Energy build or solve their 1031 problem. I started, I'm jumping around a little bit, but hopefully this will answer a lot of questions. I started BoaVida, the BoaVida Group in 2017. I had a partnership prior to that. And, but I went 100% on my own 2017 and built the BoaVida Group, which I helped with the 1031 problem for Flyers Energy. And while I was doing that, I was also growing my my existing company at the time, Cascade Corporate Management. So we ended up consolidating everything and doing a property split, which was a really great way to do it. But what happened in 2018, I went back to just me being the acquisition guy, trying to find deals. I had one acquisition guy and I had a small team, and it wasn't enough. When I just did one-off deals, syndicated one-off deals to investors, my money kept getting bumped from the deals. So, typically you want the syndicator to put money in, right? You feel safer that way. Well, most of my investors didn't want that, because that didn't leave enough room for them and their friends and so on. And I had already proven myself. So, we refinanced 2 properties last year that we bought in, that we closed in the very beginning of 2019 and the kind of middle of 2018. And we got 100% of the investors' money back. Those are 2 big deals that I was planning on putting money in that I didn't put a dime in, because I had investors gobbling up all the investment side of it. So that's when I kind of figured, okay, I got to do something different. So I put the money I had into building a team, into researching all these different markets, into studying all the different real estate asset classes, I always went back to that with, the 4 cycles of the economy, recession, recovery, expansion, and hyper supply, and looking at every other thing I could be putting money into. And I kept going back to, I'd much rather buy mobile home parks across the country. The more studying I did on RV parks, I realized that supply and demand was also very much on the side of RV parks also. So what I did was I built a team that could source deals all over the country. And then I put together a fund that we could put our money in throughout the year. And with the idea of me and all of my existing investors, with all these refinances that we were having, because all these properties that we bought, and then it was, 2017, 2018, all these refinances that were just happening, compounding. So I knew that was going to continue to be a problem. And even this year, we're currently refinancing probably about 10 different properties right now that we're working on. So all that money goes back to the investors and they want to go plug it back in. So I had to build a vehicle that was going to be able to find good, solid deals on a regular basis that we could plug our money into. And I think that's probably why most of you guys are on this call, because you're probably have the same problem to solve, finding a good, predictable cash flow investment that has tax protection. And the big difference with the mobile home parks is it actually has upside. So when you have tax protection and you have this type of predictability, you usually don't have great upside. So so that's where I came up with the idea of the fund. That was the one of the 2 main reasons I did the fund. The other main reason I did the fund was because I own 2 parks in Paradise, California. Paradise, the whole city burned down. And when that happened, I lost about 105 spaces between the 2 small parks. Every park owner in Paradise wanted to meet with me because they wanted to see what I was going to do, because I had the nicest all age parks because I had rebuilt the parks already. I basically, one of them I bulldozed, put in all new and used homes and redid it. But all the nice parks in Paradise were all senior parks. So I had redone my parks. They were beautiful. One, we had already refinanced, pulled all the money out, plus a bunch more. And then the other one, we're just about ready to do the refi. And then the fire happened, the whole town burns down. I'm meeting with all these park owners and they're devastated. They lost their nest egg. And it's funny because I had that park in Oklahoma. I always used to worry about tornadoes and stuff like that. Nothing ended up happening. And like the last thing I thought was, and if you have lots of properties, there's always like a home burning down here or something little, no big deal. But and you're diversified, 100 space park, if one home burns down, no big deal. The whole city burned down. And I'm sitting with these guys and their net worth went from 5-6 million to $1 million overnight, right? Well, I also own parks in every town that surrounds Paradise, which is Oroville, Chico, Red Bluff, and so on. So because of that, and I have both mobile home and RV and long-term RV and stuff like that. So we went to 100% occupancy. Our rents went up. So my cash flow actually increased after that. So it didn't hurt me at all. And you still have insurance, and you have so you have loss of income insurance, and we're rebuilding, and so no one's going to lose their capital, but no one's going to make any money for 3 to 4 years while we're rebuilding, right? So after that was also the clear picture to me that we needed to have a diversified fund where if one park, if there's if we're buying parks in Florida and there's a hurricane, or the Midwest and there's a tornado or a fire in California, one park gets completely demolished like this, then the investors wouldn't even feel it. If you look at our 2019 fund with 36 properties, and our 2020 fund with 31 properties, if one property, something horrible happened, it would barely affect the cash flow. And that diversification made me feel good about about, continuing to basically that was a good way to do it. So let's see. Other than that, did most of the people here, Justin, have an opportunity to read our the BoaVida 2021 slide, the presentation?
That's a great question, Eli. I would like to think that everyone did, but I'm going to assume that everyone didn't. I think that there may be value in going over it. I do get them out early, and I do encourage people to get to them. I try to get them out at least 4 to 7 days in advance. But just knowing how busy people can be, let's assume they didn't, and maybe cover some of that, please.
Yeah. So the way I do it, and Justin talked about how I kind of do things a little bit differently. I have this kind of investor first mentality with the way the fund is structured. So the simplest way. So what we do is the goal is we're going to raise $40 million to go find $120 million in deals. And like last year, that was the same goal. We ended up raising 100 million, and we bought 250 million in deals. But if we can't find the deals, we won't raise the money. So right now we've it looks like we should be able to hit our target. But the way that we structure it, I put at least 2 million a year in. I usually do. The 2019 I put 3 million. Last year I did 2.2, and this year I'll do at least 2. There's a good chance I'll do more, but I invest side by side with the investor. And what we do is the investor is the A shares, the syndicator, me and the team are the B shares. So the investor puts in all the money for 50% ownership of the deal. And the way it works is the investor gets 100% of their money back until they've received all their money back, plus a 5% per year return before the split happens. So most real estate syndicators, they give a higher pref, a 7 to 8% pref, and they give a higher split, maybe a 70-30 split, something like that. But typically, what you guys have seen is there's an acquisition fee, and in the acquisition fee in mobile home parks, you may have noticed are higher, usually 2 to 4%, not 1 to 2%. There's asset management fees, sometimes on money raised, which is very expensive. And then there's a disposition fee, or there's a fee to get a loan, and so on. I don't charge any of those fees. So no acquisition fee, no disposition fee, no asset management fee. I could basically go 5 years on a deal and not make a dollar until I get the investor 100% of their money back, plus a 5% per year return. So the goal is to buy a park for $10 million, solve 5 problems, and in the next 5 years, that new value of that park is at least $15 million, so that we can get the new loan at $10 million with all that money going back to the investor first. The simplest way to look at investing with us is you're giving us a 5% loan, but the heat on that loan is you get 100% of the cash flow from the business until you get all your money back, plus 5% return per year. After that, you get 50% of the cash flow from the business in perpetuity. And that's just kind of the very simple, easy way. The other reason I structure it like that is because we're highly incentivized to stabilize the property, return all the money back to the investor, reduce their risk to zero, and then hold the property forever. So we are not incentivized to buy stuff and sell stuff. And that is, clearly what's happening in the market when you see, things going for the prices they are. When my underwriting, and I've been doing this for a really long time, and we're always making adjustments to our pro formas. I mean, they're more in depth than anything I've seen out there. But when I can't make it work and someone else goes in there and buys it for $1 million more, and they're projecting the same IRRs, and on top of that, they're charging fees and acquisition fees, asset management fees, and these type of things. It's it just doesn't it doesn't make much sense. So, but you know, so I'm not a huge fan of the fee world, and that's why I structured it the way I did. And also, I look at mobile home and RV parks as something that you want to hold forever anyway. That, you know, that's gonna, you know, I like to say, make our grandkids useless, not worthless. It's a passive cash flow joke, you know. It's cash flow humor.
I like it. And are there questions? I haven't seen anything yet in the chat. Oh, Tamara just put something in the chat.
Do I need to open that?
Yeah, just click on the chat and you should see some things.
Let's see here. What are the average projected returns when you look for once principal is returned? Do investors participate in depreciation? Yeah, so cash flow expectations after the refi. So if the first year was 5%, then it goes up 7, 9, 11. Then the refi happens. We have a higher loan amount in our projections. We're always estimating a much higher interest rate than we have today, and so your cash flow might bounce back down to 4%. So it might have been 13, now it's at 4 because you're splitting with us and we have a higher loan amount. But typically, you know, that money's back in your pocket. If you take that, roll that into another deal, you're going to pick up another 5%, and then you have multiple deals compounding. So investors are going to benefit from the depreciation, absolutely. The way that our operating agreement reads that investors get 100% of the depreciation as long as they can use it. So let me run through a quick scenario with you guys. We buy this park for $10 million. We put $3.5 million down. We get a $6.5 million loan. So on that, the way that we allocate for taxes is typically we take 20%, and that's land. So then let's say there's an office, there's a clubhouse, laundry room. That's going to be 39-year depreciation because that's commercial. Call that $400,000 to make the math easy. That's going to be divided in 39 years. Then there's an old park-owned home, or there's an old site-built home, the manager lives in it. Call that $100,000 of value. That's 27.5-year depreciation, right? So you're not getting much from those. Now, what's left over, we call infrastructure. So roads and the utilities. That's going to be $7.5 million of value. So we typically take about 75% of what we buy a property for, and we call that infrastructure with mobile home and RV parks. So what happens is, for years and years, okay, so infrastructure is depreciated in 15 years. So $7.5 million divided in 15 years has always been phenomenal protection for us, especially with our model of we buy it, we fix it up, it's worth more. And then as our cash flow exceeds that 15-year, instead of paying tax on that, we refinance out. We have a higher loan amount, so lower cash flow. So now we're still protected by that beautiful 15-year stream of depreciation. And then we take that money, plug it into another deal, pick up another 15-year depreciation. So it was always great. Like I haven't paid federal taxes for a very, very long time. But then in 2017, the tax laws changed so that all 20-year or less depreciation could be taken in one single year as bonus depreciation. So now what happens is we buy the park for $10 million, we put $3.5 million down, we get a $6.5 million loan, and we have a $7.5 million loss year one that we can take against any, like, so unless you're a qualified real estate professional, in which case you can use it for anything. If you're not, then it's passive with passive and active with active. But it also works if you're selling real estate. So instead of doing a 1031 exchange, you could take this bonus depreciation and completely wipe out your the federal gains from the sale of real estate. So we have a lot of people that invest with us. We've got mobile home park brokers that invest with us. We've got retired mobile home park owners that invest with us, and they're all investing because of their giant either passive cash flow or their active commissions and stuff, and they have other rentals to qualify. So they're all investing like at 60 cents on the dollar day one. But there is some caveats to it. So I'm in the business of chasing good deals, not depreciation. And I have a lot of investors that just want, they want that depreciation. But I look for the deals. If there's a good deal, so there's a difference on that $10 million deal. If I have to sign a personal guarantee on a recourse loan, then the IRS only allows the investor to take up to how much they put in. So in that scenario, let's say it's a home run deal. It's a great deal, but it's got too much street parking. There's too many hitches on the homes. It's just ugly enough where in 5 years I can make it, a Fannie Mae, Freddie Mac non-recourse park. But right now it's not. And probably I can do it quicker now. But right now, the loan I'm going to get is a recourse loan. I'm fine signing a personal guarantee. I have no problem with that. The investors never sign any guarantees, and so that's not an issue. But because of that, we're treated differently, and the IRS only lets them take $3.5 million loss. So it's a one-time loss. Where if it's a non-recourse loan, then 100% of the depreciation is allowed to go. Then it's based off the operating agreement, which says all the loss goes to the investors. So then they have over a 2 times loss. So, and then there's also the situation at the end of the year, if we end up closing some deals all cash to kind of capture that depreciation, but then we get the right loan at the beginning of next year, and then we get that loan and then put that into deals the following year. So what ends up, your expectation on depreciation based on the last 2 years should be 1.3 times. So you invest, you invest $100,000, you have $130,000 loss on your K1. So even though you'll get money, that's your loss. So, and that's based off of 2019, it was 1.27. And last year is 1.33. So we're quoting 1.3 for expectations. And then the next year, there's always another chunk, like another 20 to 30%, based on what we're closing the following year with that, after we properly allocate the funds.
I've got a question. I don't want to jump the chat group, but I have a question related to that, to the loss. If you're a professional, classified as a professional real estate investor, and you're getting this loss through a K1, can you deduct against your other rental income, even if you're a professional? And I know you're not a CPA, but it seems like you've probably gotten this question.
Yeah. So if you're a qualified real estate professional like me, then you can any other property you can use this against. If I sold stock right now, I could use my federal losses against my federal gains. So the only thing you can't, if you're California, so you can't use it against state. Not this. At least California doesn't recognize a bonus depreciation. But the real key to being a qualified real estate professional is you can't just be a broker. You also have to be actively managing at least one property where you're spending. There's a 500-hour and a 750-hour test. But if you've got 3 or 4 different properties, and you have at least one of those that you are actively involved in, that you can qualify with those hours, then it's no problem. Because you actually have to aggregate your time between the different investments. Like for me, I can't spend 500 hours on 138 properties. So yet I'm still a qualified real estate professional. No one can argue that because this is all I do. Yeah. So and then the other thing is, if you have a spouse that gets a W-2, it'll actually work with theirs too. So we see that a lot where one of the husband and wife has a very high paying job, and the other one's a qualified real estate professional, and it'll actually, they'll end up getting a bunch of their money back. It's pretty wild. And this is based on 2017 tax laws from the which this bonus depreciation, it already sunsets in 2026. And it reduces down in 2023 on how much you can take as bonus, and then goes down and then stops at 2026. So we don't know if it's going to change next year. If they pass the tax, who knows what they're going to do. But right now it's good to go.
Thank you.
Let's see if I can.
A quick question, Eli. Does this count as an active or passive loss on the K1, like for the investor?
Well, it's up to the investor. So it's it's entirely up. If you're a qualified real estate professional, then it would be active. But if you're a passive real estate investor, then it's passive. So typically this is going to be a passive investment for people. But if real estate's all you do, and you file your taxes as a qualified real estate professional, and you manage all your different investments, and you spend over 750 hours doing that, then then that's fine. If you're semi-retired and all of your stuff is always passive, then it doesn't matter anyway. If all your investments are passive, then it's passive with passive.
But you can choose that as the investor. Like let's say, because my understanding was if in the fund I might be still a passive investor, but I'm still a qualified real estate professional because I have other active real estate investments that I'm active in.
Do you file your taxes as a real estate professional?
Yes.
And are all of your real estate investments passive, or do you have anything that you manage yourself?
No, I manage myself a few of them.
Yeah.
So I group it all together, and I get the status. But my question is then, if I have a loss from this fund, because I have other funds that I'm in, and some of them, they are classified as passive losses. So then I can only take them against passive income from my understanding.
So it depends on if it was recent, while you were still managing real estate and doing if it was while you're, if nothing changed from what you just explained to me, and you are actively managing, other real estate, you're the manager, you're either the property manager or you're the GP on some deals, and then you have, 5 other ones where you just plugged in $100,000 to be a limited partner, you're still managing those investments. You're still spending time evaluating those investments. So you would aggregate the whole thing. So you may have, or one of your tax guys may have wrongly qualified it because, they didn't understand the way that the law works and and how you're supposed to aggregate it. But if they didn't do that, then they would have locked it in as passive, and now it's just going to help that specific investment. But if you find someone, a CPA that really knows what they're doing, then they'll know that they're supposed to aggregate that. So the real test is, so once you're a qualified real estate professional and you're really active in managing, it sounds like a couple of different things, then all your other real estate investments are gonna all work together. So
even in funds or things like funds, basically. So even if I have direct properties that I'm managing, and then I have LP interest in funds, I can choose to take all of those LP losses against all the active income, because it's all coming under the qualified real estate professional.
Yep. No, we have, I've got a broker that gives me at least $1 million a year, and he owns just a couple real estate deals that he handles himself. And then he invests with me, and he's able to take that his, $1.3 million loss and use that against his commissions, use that against his income on his other stuff. It's that's how you're supposed to do it.
Yeah, I'd love to chat with you further about that, and maybe even talk to one of the CPAs you use to get clarity on that, because I've had my CPA tell me something different on that.
Yeah,
one.
I'd like to talk to your CPA too. It sounds good to me.
Yeah.
Yeah, because I challenged them on that. I did challenge my CPA on that, but he came back and said, no, you got to treat that LP. You're an LP in there. You're not active in there. You're not spending 750 hours there. So that's a passive loss.
So, and that goes back to my argument. Am I spending 750 hours managing any one of my properties at this point? Like, it'd be impossible.
Right.
So
I saw that you have to I think every year you're supposed to file an election to lump all of your properties together basically as a portfolio, which I think is anyway, you can even go back and amend your old returns to do that. But
I would recommend you don't go back and amend anything because that is a red flag to the IRS. But moving forward, I would just do it correct. Just do it correctly.
So you wouldn't change, Eli. You wouldn't change like if the past LP interests in other funds or whatever were classified as passive, you wouldn't suddenly then start taking it as active loss.
So
from this year on.
Here's where probably the best thing is for if you guys are serious about doing some investing with us, then what I like to do is get my CPA on the phone with your CPA, and then they just talk it out. And my guy is really good, and he knows the code, and he just goes through it. Through it. And typically and then we've done this, I don't know how many times we've done this with, we have obviously very wealthy investors, and that they have just a large group of different, everyone's got a different CPA. The problem is a lot of the CPAs are not real estate guys. They're not like real estate guys where they're like real estate investors. And I don't want to bad talk, but it's just, there's so much to know there. These guys are real estate guys, and they can go through and reason and explain it out. So I'm happy to, we could set something like that up.
And that would be great. That would be very helpful, actually, because that is a big part of, obviously on top of the fact that the investment is sound and there's cash flow, but having it tax optimized is a great thing, especially the way you're describing it. I've had mixed feedback from CPAs on being able to take those losses. So it'd be great to have that call or
and that's common. That's common. I mean, most of the guys have to get educated on it. Especially on at first how the bonus works, and then how the qualifications for active. And but yeah, I'm open to setting another thing up with our CPA and kind of going through there. So should I just keep going to questions?
Yeah, let's move through the questions. We got a handful.
You want me to pick them?
Yeah, why not?
Do you self-manage? Okay, so we own and operate all but 26 of the parks, 26 of the 138 parks we own, but we have brought in 2 different third-party management companies that we have great relationships with. They use the same software we use. Now I have one of our top guys who is our asset manager that manages them on a regular basis. And this also kind of, we don't charge an asset management fee. We charge a park by park management fee, which is typically 5% of the revenue. So if we hire a third-party management company, they collect that fee. So even though we're spending money managing them, we basically just lose money on that. That's not a big deal. But But yeah, so they'll collect that fee and they'll do the, all the accounting and all the day-to-day, and then we manage them. Actually, our guy, Jason, he has a weekly calls with both of those companies and just dials into the P&Ls, and he just does such a good, he knows utility billing so well that he just helps them. So it's almost like he's got his own two teams working these parks, and he can just help them tweak stuff to make everything work. But typically, if we think we're the best people to manage it, we'll manage it. In some cases, like Michigan, we like these Michigan, South Carolina, these companies, they have all the resources, they've got the relationships that I have in California, in these other states with the contractors and to bring the homes in, and the dealers, and just all this stuff. They have those same relationships. So if I think they can do a better job, I'll have them manage it, and then I'll just manage them, or my team will manage them.
So in Michigan, are you guys using M. Shapiro Group and like kind of beyond there? And
yeah,
what's your feedback on them? I've gotten mixed reviews.
Well, I think they're really good. I think they're really good. We have a really good process with them.
Okay.
So I mean, I'll give you one example. I'm most of our parks with them. A lot of our parks are stabilized, but a lot of our parks are projects. So Southern Michigan, I didn't want to buy Southern Michigan, but the numbers worked, so I did buy it. 150 spaces, about 40 vacant spaces. We pulled out 20 spaces of old homes. We bought it in the end of 2019. We just got an appraisal north of 8 million. We bought it for 2.7 and put money in it. We're in at 3.3. We're getting a $4.5 million loan today on it. So we could not have done that without them. They did it very fast. So they did that at the speed that we will do that in the Western states, like no problem.
So they're actually adding, they're not just doing property management, they're actually filling vacancies.
One of the reasons that I'm using them is because my relationship with 21st Mortgage. So I've got, a $30 million line with 21st Mortgage. I said, who out there, when, this is 2018, when I was doing my research of how I'm going to grow like this, who out there is good at the home side of the business? Anyone can manage a park. They're either going to do a good job or a shitty job. Like, it's pretty easy to, but who can actually like fill homes, sell homes and solve problems? And their name, kept coming up. I mean,
who's the other group that you're using?
TrueBuild.
TrueBuild. Okay. And not to be confused with True Homes, but I guess they're trying to make a play on those, because are those the homes that you're using out of 21st?
They're out of Southern California, and they're just kind of a smaller operator, and they're trying to buy some stuff on their own. We bought a park from them. We liked how they're operated. They do a better job than we do on getting everyone to pay online. That's always a challenge, and they do a really good job with it. So we like. But again, I like them for the states that they're good in, that they have those resources. And then I manage them very well because we know the business so well. We know where people typically will miss stuff. So I think both of the companies are probably learning a lot from us also. Yeah.
Okay.
But so we're open to a combination of but the majority of the stuff we operate.
And for those of you that are unfamiliar, the 21st Century program is a program where you can get these brand new homes, very nice homes, Clayton homes, that are delivered to your property for free. They're set and everything for free, and then you find a renter or a buyer that basically contracts on the loan to buy that home. So it's the most inexpensive way to get a home in your park.
It's not, I mean,
there are a bunch of rules and conditions.
They give you a line of credit, and they're flooring the home, they're flooring the transport. I've negotiated actually even a better deal than that, but
What are yours?
I don't know if I can tell you.
No?
No, I don't think my guy, our rep would like that.
Okay.
But most people get the, yeah. I mean, I'm one of the biggest, so I'm gonna have special deals and stuff. But yeah, so you can either sell the home, you can do a rent to own program where they'll accumulate their down payment, and then you need to follow up and get that convert that to a sale, because the real goal is to not have a bunch of rental homes, but you can kind of start that out and only move people in that qualify to buy the home. They just need to build up a down payment. So that's kind of the key to that program. So, and they're very picky who they'll lend to. I mean, I know guys have been very aggressive buying for the last few years, and they won't sell to them, and then I know other guys that have unlimited money, and they won't sell to them either, because they're very relationship oriented. So if they don't like, if they don't like you, they don't do business with you. It's I actually kind of like that.
So you're not doing the cash program, you're doing a variation of the cash program?
It's the cash program.
Okay.
It's a cash program, but everything's negotiable as far as the parameters of it.
Okay.
So okay, who would take over the property in the event I was not around? Okay, so we have a great management team. Our management team's in place. The main thing that would stop is the buying. So if it was in the middle of us, completing a fund, then we would just stop buying. Any extra money would be distributed back to the investors. And then as far as management of the fund, there's 3 people in the GP entity. There's 3 people that named that would take over management in the fund. And then also if my wife's around and she doesn't get hit by the same bus or something, then she knows the business very well. She actually ran the loan business on my previous company. I had our own loan mobile home loan company, so she knows the business very well. If neither one of us are around, basically there's a list of which people would take over in the event that, so that's all kind of laid out. But I'm not out there buying more problems, and so no more buying, no more growing. It'd be all about stabilization. The other thing is, when you have the A shares and the B shares on each individual deal, because the fund is the investor. We all put our money in the fund, and the fund buys up all the A shares and all these different deals. Well, on the B side, you have me and a bunch of team members. So you have a bunch of team members that get these pieces of preferred equity. So their goal is to work their butts off to get the investors their money back, so that they build equity, right? Everyone's paid really well, but they're also here, so that they can build wealth. So so you have other people involved with the ownership mentality of stabilizing these properties as quickly as possible. So that's kind of that's just kind of a great way to do it, because then if something does happen to me, or even if I'm busy over here, busy over there, each park has 1 to 2 to 3 people involved in stabilizing this property, because they want to build wealth. And that's how we've set the company up. How many parks have we purchased since the fund opened? This year's fund, normally I do this in my office. I have a list up here. I think we've only closed 3 deals, and we have several deals that we're getting very close to closing. We've got a portfolio of 4 parks in Oregon. We've actually got a 5th park in Oregon. We just got under contract, but I want to say we've only closed 3 or 4 deals this year. So it's kind of typical too, because I feel like it ramps up every year. But we do have several deals under contract. Do you target stay away from certain geographies? And if so, what factors? So yes and no, but like once the further like outside, the western states I go, I try to go bigger, so it's got to be bigger properties and bigger metros and that type of thing. At the same time, like the deal I told you about in Michigan, it was a nice like subdivision style park, with no real amenities other than that. It was just buying a subdivision in like Battle Creek, Michigan. So, and it was 150 spaces. If I was, so there are so many reasons, like if you're just looking at demographics, like you wouldn't do that deal. The first park I bought was in Oroville. It was like a suburb of Oroville in California, which is like at the armpit of California, like a drug capital armpit. It's horrible. But we made, I've made my first $1 million there, and every quarter I pay myself a nice check there. So that's the beauty of this business, is that people need affordable housing everywhere. So we have to understand the market, like whether, like we're passing on deals right now in some markets in Georgia that we have under contract that we're walking from because it's a complete rental market. Like we don't ever see us getting out of the rental home business. And, but we had to tie it up because it was a clean deal. All city services, it looked like everything worked, but when you dig into it, it's just not a market that we want to be in. So
do you assign those contracts, or do you just give it up? You just walk? Because you could stand to profit a lot by assigning those and rolling it into the fund.
You mean rolling it into someone else's?
Yeah. Whenever you assign a deal to someone else, take the profit and roll it into the fund if you're buying on the fund's behalf.
Yeah, I don't know who I'd market a deal to. I mean, I'm not really in the business of saying, hey, this deal's not good enough for me. I do get people that ask, hey, if it's a deal you pass on, I'm like, okay, well, what if I pass on it and then they don't end up making money, and then I don't know. Like, so what? So I make $100,000 on it. I don't know.
Well, you might have a captive audience here that would be interested in deals that you don't do that you would assign. So I'll just throw that out there as an opportunity. I
have several investors that have bought mobile home parks, and they've made more money investing with me than they have on their own parks. They would tell you that.
That's
guys
good.
like,
That's real good.
Guys like, I'll mention a couple of names, a guy named Scott Wheeler, a guy named Don Beckman. So I don't know, but it's something to think about. But my thing is, as long as the broker's taken care of, I just never want to do anything that upsets the broker, because they're really our lifeblood.
Cool.
Let's see. Your deck is very high level. How did you arrive at those returns, since not all parks are identified? Yeah, it's all projections, and it's all very conservative projections. And that's why we have like the random sample of one of my longtime investors. Like, we just looked at his parks, then it's like what, 27% per year return or something like that. So instead of us picking, we just picked one investor that just basically invests in everything I offer for him. And now in the funds, he just matches me dollar for dollar, however much I put in, he puts in.
Oh, that's nice.
But, yeah. So, yeah, and then also the do we target certain states? We totally want to just do business in certain states, but at the end of the day, it's where's the deal? Where's the deal that we can identify, that we can basically solve the 5 issues, passing through the utilities, fixing the infrastructure, filling up a bunch of spaces, filling the occupancy, and then getting rents to market. So, if we find that, whether it's Oregon or, but obviously we'd love to be able to find opportunities in Tennessee and Florida and Texas. That would be my, and I mean, really the mountain states are phenomenal too, but it's just a matter of, can you find the deal? How does an investor cash out if they do not want to own a property in perpetuity? So, when you get your money out tax-free from a refi in year 5, you typically don't want to sell if it's going to keep paying you. But if something happened and you just need the money and you want out, then I get the first chance to buy you out. And then if we can't make a deal, it goes to all the other limited partners. There's never been a situation where someone's wanted out and it's gotten past me. It's usually earlier on where just something happens. They're like, and then it was like a year later. So I've just turned around and said, okay, well, here's, a 5% or here's a 10% return and your money back. So I did have a guy recently, I helped him with a 1031 just park some money. Then I bought him out of that, and we just came up with a fair price. And then it never gets past me and then even like all my other investors, we're all dealing with the same problem on a quarterly basis of there's money, and we would always love to buy what we have. So it wouldn't be that hard to get your money out. But the goal is to own it forever, and just get the money out through refi. And really what's going to happen is, in our projections, it's a year 5 refi, but then that's probably a non-recourse loan amortized for 30 years due in 10. So in 10 years, we're going to harvest it again. And that's not on the pro forma. That's not affecting the IRR. I'm not showing that, but that's really what's going to happen. So there'll be, if you have 10 different properties with us that we bought, one a year or whatever, like you're probably on average going to have 10 harvestings a year, one harvest a year. So you're always going to be in a situation where you have money, you don't have to sell anything. And that's a great situation to be in. Minimum investment is $100,000. Average investment is probably $500,000. I think we've raised somewhere between 20 and 25 million so far. All the institutional money now competing in the space. How confident are you in the targeted returns? Here's what I did last year, because I had more money that wanted to come in, and I had some really nice, clean deals that I liked. And I thought, you know what? It might take 6 years to refinance this. It's a little more stabilized. It's a beautiful park. I'm going to be thrilled to own this. My investors will be thrilled to own this, but I can't get the IRR to 15%, with a refi scenario. And so what I did was I just structured the deal so that it was a 6 pref and a 60-40 split for the investor, because I can structure the deal anything better than a 5 pref and a 50-50 split. So I structured several deals last year as a 6 pref and 60-40 split. So all of a sudden I had 10 more deals I could buy. So I'm always one of the biggest investors, and I'm a fiduciary for the fund. So, if it makes sense, then I can, juice up the IRR for investors by swaying it, to, and that doesn't mean, by the way, that that there's not a 5 prep 50-50 deal that's the investors will actually make way more money on. It just means that I'm structuring that deal, more favorably to the investors, but the deal itself, is more a stabilized, cleaner park with less lift. Yeah, there's other ones that we're projecting a 17% IRR for the investor that's structured a 5 prep and 50-50 split. So
there are a couple of questions in here on like competition. I think it'd be interesting to know kind of how you feel you size up against some of the other people in the space, like, a Four Peaks, like Haven Park, like Open Door, MHC America isn't accepting new money. or, new investors, but I'm curious, any of your thoughts there would be interesting.
Well, I don't know their structure that well, but so I would just assume that they charge fees and that they're,
They all
to
do.
get to, to get to the return that we're getting to. So in other words, if I use a sales scenario, I would be projecting much higher IRRs. If I said, well, we're going to flip it in 5 years or flip it in 10 years, then my 15 or my 14 would be, a 17 and 18. So, but that's not really the goal, and most investors I talk to, like, it bothers them when they're making money on something and then it sells and then their money is sitting there. So, so I'm not incentivized to buy stuff. I'm not incentivized to sell stuff. I know I've got a better relationship with, on the home side of the business, we're doing a lot of the, bringing in homes. I've got that foundation of being a licensed contractor, crawling underneath the homes, understanding the sales side. We're not just money raisers buying parks. But I think a lot of those guys do a good job. I think there's a lot of bad operators out there that still make money. Like, especially in today's market, there's a lot of crazy offers out there, and we're missing things by, we're losing out on deals by $1 million, $1.5 million off on what we think will make it work. So time will tell. But at the same time, it's, the mobile home park business is very forgiving. So you can be a mediocre bad operator in some markets and still make money. I think that we're a pretty darn good operator. But we've had, we put in the time, and we've done all the different parts of the business where I think a lot of these guys haven't. So, yeah, but I don't know that, I don't know them that well. I know a few of them, but I've done business with some. I think, we bought some stuff, I think, from Haven Park, and they flipped it and made great money. But there's so much meat on the bone because they couldn't fill up the spaces, and and I think they had some reputation issues or something. But I think we're better at bringing homes in and selling the homes.
Yeah, I know, Robbie, and I think that, there are definitely strengths that each of you guys have and what your funds bring. I think it's great that you're able to fill as quickly as you can fill. And that's where you're going to make the biggest money, is by filling vacancies. Cutting expenses is nice, and you can do that, but filling vacancies is where you make money in this business. So if you can do it quickly, with a good product that people want to stay in, that's the magic. There are a few other questions in here, just to summarize. Just to get an idea of what the cash flow looks like. So number one, is it a capital call structure? Is it all money in at one time at closing? And then number two, does that pref start at 5% paid out, or does it accrue for a period of time? And then number three, I think the answer was at 5 years, when you refi, you get your money back, and at which point in time the split begins, and you would start to make money. And I do like that you guys don't have fees, so you don't make money until you actually see results. So there's some alignment with the investor there.
Yeah. So because it's a fund and it's not just one park, refinances start happening early. So some are going to pop year 2 and then year 3, and as those refinances happen, the money goes from the park LLC to the fund, and then from the fund distributed out to the investor. So for example, in the 2019 fund, that Michigan deal is our very first refi. So, but if you look at the refis we have lined up from here on out, every single quarter, we're going to have a refi from, I don't know if it'll be forever, but probably until they're all done. But we have like 5 or 6 refis from the 2019 fund lined up, and we'll be doing at least one per quarter. So
Eli, that's a really good selling point to investors. I would fast forward that into what you're sharing, because I think a lot of people like to know that they don't have to wait till year 5 to get their money back, that they're actually going to get it periodically from years 2 to 5, or however that starts. I think that's really good info.
So the first year, we we've just been getting commitments and setting them up in which month we think we'll need those commitments, and then calling that money as we're getting closer to closing deals. And then when the money comes in, what we do is 5 days after that hits our bank account, we accrue that money at 5%. And then at the end of the year, basically first week of January, we send out a true up check. So that way, everyone's just making 5% their first year. And then we true it all up. So there's no distributions the first year. We true it all up in January. And then after that, it goes to normal quarterly distribution starting April 15th, based on the cash flow from each property up to the fund. And that's how we do the distributions. It was just kind of like the simplest way to do it, because we're closing deal, money's coming in, we're supposed to close a deal, and then the escrow lasts another 30 days or whatever. So the whole acquisition period is always very messy.
Great. Anything else? I think we've covered most of these. I guess Dinesh has one here. Do you want to take a look at his last question in there?
With the fund structure as 100,000 investment, for example, how would that be allocated across multiple deals? So if the fund invests in 20 deals, then it's at the end of the year, once we know the dollar amount that is raised, then the investor gets an ownership percentage. So if they own 1% of the fund, they're going to get 1% of the cash flow from the fund. And if the fund's invested in 20 deals or 30 deals, that money is allocated across all the deals.
I guess my question is it more heavily weighted in some deals versus others, or do you have like a hard, like it's not going to do more than 10% of the fund in one deal, for example, or 5% of the fund in one deal? Or do you go heavy on some deal, like 30%, and then you got much smaller in other deals?
No, it's typically going to be all the investment in all the deals. So it'll be evenly. I mean, you could have one deal, I guess, that was a $30 million deal that we put $10 million in, and then one deal that's a $3 million deal that we put $1 million in. So yeah, more of the money would be allocated, but it's all pro rata. So it's.
But it could be overweighted in one project.
Yes, it could. Let me give you a quick example of so one of the first deals we did in the 2020 fund last year was a $20 million deal in Wichita. And that was going to be an $8 million, we needed to put $8 million in that deal. I really like the deal. I really like the park. I like the market. I didn't like putting $8 million of the fund's money in it. So I do have the flexibility in the fund to charge a 1% acquisition fee and 1% asset management fee if I do a 7 pref and greater than 50-50 split. So what I did was I structured the deal I used CrowdStreet to raise the money. And I did this because the previous year I did a deal with CrowdStreet, and I didn't like that the fund couldn't go in it because it was a deal that one of my investors got me, and because he was a trustee, because he was involved in the deal, he couldn't invest in it. So it had to be a separate deal. So it couldn't go into the fund. But so this deal, the way I did it was I put $1 million, $1.5 million of the fund's money in the deal. And so the fund's getting a 7 prep and a 70-30 split, side by side with a bunch of CrowdStreet investors where we raise the rest of the money. So in other words, as a fiduciary of the fund, I love the deal, but I didn't want it with the mentality of with the idea of I was going to raise 40 million. I didn't want to put 20% in Wichita. So so thinking about the same thing that you're kind of thinking about now, how do I still invest in that deal, but not allocate too much money into that one deal?
Yeah,
And
you could
that's-
do sidecar deals too. I mean, I'm in other funds where the fund will invest a certain amount and then they'll offer their investors, their LPs, a sidecar deal to directly invest with different economics.
Yeah. Yeah,
So you
and
can
that's
also-
basically what I have some flexibility in the fund to do that. And that's why I had, if we do a seven or more pref, and because a lot of these other things, so if we want to take down a $50 million deal and we need a big investor for that, and they're stuck on the old mentality of, well, we need to be a 7 pref, but they're fine with paying fees, then we could still invest in a $50 million deal with the fund, and partner with a big, family office or something. So
Yeah,
we
I'm
got the
guessing you don't.
flexibility to do it.
Yeah, I'm guessing you don't want to be overweighted in the fund on any one deal. That's the biggest thing. That's the biggest benefit of the fund, is it's diversified and it's not overweighted in one project, even though you love it a lot.
Yeah, I mean, it depends. I mean, if you're buying in LA or something, you'd probably be fine putting $8 million there.
Sure. But as a percentage of the fund, if your fund was only 10 million or 20 million, that's probably too heavy in one deal, right? If it's $100 million fund, then maybe different.
Right.
By the way,
And I don't know if
Hans
you
and I-
answered, sorry, one quick last question is it a capital call, or like, is it called per deal, or how is that? I don't know if you answered that. I might have missed it.
It's basically a capital call. So we give you kind of an expectation of when we think we're going to need the money. And then as soon as those deals are getting closer to closing, that's when we shoot out an email. Okay, we're ready to go. So we'll already have you filled out all the paperwork and everything ready to go, with an expectation that we're going to need your money in August. Depending on how much you're going to put in.
So if you committed like 100K, then you get all of that 100K called when the next deal comes, or is it like, okay, we need 50K for that one?
No, we're just going to call the money. We're going to call the full commitment from that investor. Same thing if it's $1 million, then we're going to say, we're going to plan. So we're going to plan, a total of 4 million, needing $4 million in August, right? And so we'll just have a list of people that adds up to the 4 million. So.
That's
and
good.
then if I invest that, you call it in August, but then there's already other properties in the fund, that money is getting spread across. You're getting pro rata share of everything else that exists in there too.
Right. Yeah.
And is
it
at a stepped up basis? Is it at a original basis or stepped up basis?
No, that's why. So as far as the depreciation, you get the depreciation for the whole thing, right? But as far as your return, that's why we're not basing your return the first year off of cash flow from the properties. We're just going to accrue everyone at 5% and just do a cleanup the first year, and then after that, starting January is when we do distributions based on cash flow. And that was just an easier way to do it, rather than, because a lot of funds are like, okay, we have to pay more to come in late, or it's just too, we're trying to allocate, like, you getting a return from these first couple properties, and then we just said the easiest way will just be accrue everyone's money at 5% the first year.
Got it. So no cash flow in the first year. After that, so your 5% starts accruing from the time you invest, so it doesn't matter when you come in.
Right.
Got it. Thank you.
And Hans and I think, looked at one of your deals that was on Crowd Street. I don't know if you remember that, Hans. So one thing that Hans asked that I think is really good, are you able to provide a comparison of original projections versus actuals to date for your prior funds? I know you're still in these funds and these are long-term, and it's probably hard to, say exactly where you are, but to date, it would be nice.
Yeah, we can do that. I mean, if you just shoot me an email what you're looking for, I can do that. But like I said, with these refis that already started, that Michigan deal is we weren't planning on refinancing it in 2 years, right? There's one in Fresno that we bought in 2019 fund. That's a 5-year deal. We're going to refinance it in this year. There's a deal in Desert in what's it called? Las Vegas. We're going to refinance that this year also. So those are all 2019 deals that probably had a 5-year. If you look at the pro forma, yeah, I'm sure it shows a refi in year 5.
I like it. Well, what we need to do is we need to wrap things up here. I think that we'll have people that are interested in investing. Hans asked if we can get a PPM and CA before we commit. I'm guessing the answer to that is yes. We'd love to see that. And we'd love to, see any other information that you're willing to share with us on past performance. So this has been awesome, Eli. I appreciate it. And it's also really fun taking a look because we've touched base now, I don't know, a few times, and it's nice seeing the progress and seeing the results that you're getting, which makes me feel good because anytime groups have a lot of money to deploy, I always get nervous. Are people just buying up property because they have to deploy the cash? And it seems like you guys have a process where you are really picky. If you're looking at 100, deals that you get under contract or get close to get under contract to pick 20. I like those stats.
Yeah. I think this year there's a lot of that going on, though. There's a lot of that going on, and we're seeing it, and it's making this year very, very difficult.
Yeah.
But I think our relationships will work out, and we'll still find some good deals.
I like it. Well, if you can post your contact info in the chat or your assistants, whoever you want reaching out, I think that would be great. We'll have some people connecting with you. And to answer one other question, it sounds like this fund's going to stay open until the end of the year. But the sooner you get in, the sooner your 5% accrues.
Yeah, I was going to ask one more question too, Justin, which is that if, let's say, we get on the list before you call capital, do we have a range? Will you say we'll be calling capital Q3 just so we know we have the money kind of handy to invest when you call it, or how does that work? And is there a chance that we can get on the list and it gets filled up and you don't get the,
No, I mean, you're going to get priority. You're going to get priority. Unless something happened, we just stop finding deals. But so I think Eric Resnick, one of our team members here, he keeps that calendar on who's up. But we're gonna I think he's given everyone like a 30 days heads up. So because they already kind of know, but then I think he's given them a 30-day.
Very good. Well, thank you so much, Eli. We appreciate your time. This has been really informative, and we got your email, your phone number, so people can get in touch with you. And I will likely reach out. Like if you can just send me or have your assistant send me any of the other documentation, I can just get that out to the group to save the one-on-one back and forth. But direct
that'd be great.
questions should go to Eli and his team. And then later today, as long as there's time, I'd love for there to be time. We can kind of dissect this a little more because I've been, this is my industry that I've been in for about 15 years now, and I love it. So any of the questions that didn't get answered, we can definitely tackle them. So Eli, thank you. This was awesome, and hope you have a good one. We'll be in touch.
Thanks, guys.
All right. That was part 1 of today. I'm really also excited for part 2 of today. And when we're done with part 2, we can discuss a little bit more questions regarding all this. But I have my new friend, Ed Vincent, joining us here today. Ed is a very seasoned entrepreneur that has been in the startup world for quite some time, has had some successful startup exits, and really has just a lot of expertise in this space. In fact, he wrote a really cool article on raising money and the common pitfalls that people make and the dangers around VC money, which I fully agree with, and just other ways to do it. And it's so cool that this time around, he's got a business where he can do it differently and not go the VC route. And with some of the new regulation around crowdfunding and the ability to raise money in different ways, it allows an entrepreneur to truly bootstrap a company and to raise in a way that doesn't dilute the founder in the horrific ways that VCs generally do. So Ed started a company called Festival Pass, And I just think this is really cool because the industry, you guys saw from the email, this is a monster industry, the industry of live events. And I'll let Ed go through all the details, but we got a chance to get together just the other day and talk through this. And I got a chance to hear his story and where he's been. And he is new to Austin, and we're so glad to have him here. And I just love this idea and wanted to expose it to the group. There is a very small raise available. So this is going to be, more of an equity type of play, non-cash flowing, unlike most of the deals that we do. But I think that the idea here, this general concept, has some legs. And for me, when I invest in companies, it's less about the company and the idea and more about the entrepreneur and their track record. And Ed has that. So Ed, why don't you take it away? You have the ability to share the screen if you want to, or just talk, whatever you want.
Thank you. No, I appreciate that. And thanks for the warm introduction. And it was great to meet you the other day. And I'm sure collectively here, we probably all have some intertwined relationships in the entrepreneurial world. I thought I did not know what the context of the presentation would be. So I thought I would just start by getting everybody kind of in the mood for what we're going to talk about. And then we can jump into just more of me walking through a few things. I'm sure you don't really want to be taken through another deck, but let me just go ahead and share screen here. Can you guys see that?
Yep. The sound is a little muted, but we can see it.
Well, cool. So that was really just to give you guys a feeling of the world of live events we've all not been a part of for the last 12 months or so. And I'm sure everybody here probably loves live events. The thing that's so interesting about it, and I'll give you some context to the why. Everything for me is always about the why. Why did it come to this point? But it is a $200 billion industry. And it really hasn't been innovated on in a long time. And I'll get into a bunch of that. Sometimes when somebody asks us to kind of explain, well, what is the business model? Why are you different than a ticketing company? Why are you different than, things that have been done before? And the easiest way to explain it at a high level, and then I can talk about all the details behind it, but it's like Airbnb meets ClassPass for live events. And the reason why those two things are important is because Airbnb is a marketplace, as we all know, and was very successful in creating a two-sided marketplace for hospitality when you have lots of rights holders or lots of owners of things. And in the world of live events, a lot of people have heard of some of the big producers of Live Nation or AEG or others, but a lot of people don't realize that on a global level, this $200 billion industry is there's tens of thousands of players that are rights holders across the globe, and some of the big teams really only represent 10-15% of the total market. So I think the easiest way to kind of lead up to the why, and if you guys feel free to ask any questions along the way, but to give a teeny bit of background on myself, and Justin was very kind in sharing that I've been through a little bit in the good old entrepreneur world. I'll try and go fast through this because I don't want to bore all of you, but I've been an entrepreneur for over 20 years. I was a banker up until 1999. Then I started my first e-commerce company. I sold that in 2001, had an agency through the 2000s, about a 70-person agency. That's when I started loving what live events were. We had an experiential marketing company, and we helped a bunch of film festivals launch and get created. We brought big brands into lots of big music events and tours. And during that time, I just really began to love live events as an industry and a concept. since then, I've gone on to, I built a SaaS business that I sold in 2014 in the franchise and multi-unit space. And then for the last 5 or 6 years, I had a data consultancy and a software platform called Predict Analytics in the entertainment space. So we helped a lot of big television brands like A&E Networks and AMC Networks and people that run ads in front of movies, really help understand their entire data structure. And I bring all that up because what we're building for Festival Pass is very data-driven process and company. Along that time frame, some people here, assuming most of you in the United States, may have heard of a company called MoviePass. And MoviePass had a very interesting ride, meaning that they truly had a good product market fit, meaning that there are a lot of people that wanted to consume entertainment in the form of a subscription. And they grew to having 3.5 million subscribers, but MoviePass had a couple issues. One issue was their core underlying business model wasn't that good, and the second was the way they financed the company was even worse. But I was asked, because of my data experience, to actually go into MoviePass as their interim chief data officer, and I spent 18 months there alongside the leadership team, understanding the good and bad in everything they did. So they did make a couple critical mistakes along the way, but along the way, they did change the industry, and they changed the way people think about subscription consumption, not only in the streaming world, like the Netflix and Disney Pluses of the world that everybody knows, but also in the way subscriptions are used elsewhere. In that process, and I'll kind of get to our model, is there was a company called ClassPass, and if anybody here knows what it is or doesn't, I'll explain. It's a subscription model, and it is for gyms and exercise. So people can sign up for a monthly subscription, and they can go to a Pilates class or a yoga class. But what they did different than everybody else was they had launched back in 2012 and had many of the same problems subscription-based businesses had, until they got to a point about 4 to 5 years ago when they changed their model to a credit-based currency. And that was the vital key that enabled them to move to positive gross margin unit economics for every transaction and every member, which then allowed them to grow into 30 different countries and be valued at a couple $2 billion. And even today, I think I read last week that ClassPass is looking at merging into a publicly held SPAC valued at more than a few $1 billion. But the reason that was interesting is it brought my attention to the credit-based currency model. And once I did a lot of research into it, I realized how powerful it really was, that you can have a subscription, a monthly subscription, which is recurring revenue for the consumer, but you can do so in a way where you can guarantee positive gross margin metrics on every transaction. So when I took a look at the overall live events industry and I realized the opportunity that existed, it is a growing industry, and the younger generations, the millennials and Gen Zs, in addition to everybody, not only do they put experiences at the forefront of their discretionary dollars they spend, they're also used to and have grown up in the subscription-based world. So it's the way they prefer to consume certain forms of entertainment, like they do through all of the live streaming subscriptions, like they do through ClassPass, and like they do through other forms of subscription-based entertainment. So that's the basic high-level reason why we came to create Festival Pass. And the one important thing to note is, even though the name is Festival Pass, we're all about all live events. So it's everything from sports to theater to concerts to small independent music venues to festivals and everything in between. So it's attacking the entire business, not just the small sector of festivals, but using the brand Festival Pass really evokes an emotion and creates this experiential feel for certain demographic groups. So that's the general concept, but digging into the business a little more, it gets pretty exciting. So one of the things about marketplaces, and especially subscription-based marketplaces, is there's a lot of aspects that it proves to enable a successful marketplace. The ones we all hear about today, like Airbnb or Uber or Lyft or DoorDash or Grubhub or any of those, they all sustain based upon a couple core reasons. One is making sure you have a route density effect or a global density effect. The route density effect means people can create a marketplace on a local level, meaning that you can have individuals. If you have enough individuals, for example, Uber's an easy example of a route density marketplace. If you have enough people wanting rides and enough people willing to be drivers for rides just in Austin, Texas, or just in New York City, you can have a individual marketplace just in that local region. Airbnb is a good example of a global marketplace, whereas most people don't utilize it within their local environment, but when they go out and they engage to travel elsewhere, every piece of inventory that gets added to the marketplace enables a bigger and bigger marketplace to build. What's pretty cool about Festival Pass is we actually benefit from both a route density marketplace and a global density marketplace. Similar to the way Airbnb might benefit, Uber might benefit when you use it in your own home city, but then when you travel to another city, you already have the app, you already open it, and they're already there and available. So that's one aspect of it. There's a few other things that are pretty interesting in the marketplace dynamics. And one is a transaction. So if a transaction happens, you either need high volume transaction with a low price, or you need a high price with a low volume. We also benefit from that because live events are traditionally a higher ticket item. So the way we price our company, when people come and sign up, they spend anywhere from $9 to $99 a month. And each level of tier, they get a certain different amount of credits. And the higher monthly subscription they commit to, they get a better price on the credits. And the reason why that's interesting is on a subscription level, the world gets big pretty fast. So when we talk about the numbers and MoviePass having 3.5 million subscribers back in the day, they did at a $10 a month subscription. What we're doing is for a company like ours, even at 100,000 paid subscribers, and let's say at an average of $49 a month, for that, we're already at a $60 million revenue business that is inherently profitable because of the simple fact that every transaction that happens through our system is gross margin positive metrics. So when you look at a $60 million business with only 100,000 paid subscribers, that's a multi-$100 million valuation in a recurring revenue business model. So I'll stop there on the business part itself and see if there's any questions. And then what gets pretty interesting is how we're financing it and where the opportunity might be. So does anybody, while I'm sitting here, have any questions or comments on the business itself? Nope. Okay. No worries. No worries. So one of the interesting things we're doing on the financing side, as Justin mentioned, in my past, sorry, I'm getting a little feedback there. I think maybe Steven's iPhone. Okay, so
I just muted him. You should be good.
Perfect. Thank you. So in the past, I've been through multiple different forms of financing for my startups, from venture capital to bootstrap to debt capital to some private equity capital. And, each one comes with their pluses and minuses, as Justin mentioned. But the one thing I've always wanted to do throughout my entire entrepreneurial career is truly crowdfund a portion of the financing. And it wasn't until this year where that really became viable. I don't know how many of you here on the phone know about the way Reg CF works, which is what they could call the crowdfunding designation with the SEC. But starting this year, you're allowed to raise up to $5 million a year through Reg CF crowdfunding. You could also raise up to 75 through a Reg A, 75 million a year. But even on a smaller level, by moving from the traditional $1 million a year to 5 million, it made it more of a competitor to the world of VC, where there's enough money to substantially grow a company with a $5 million a year raise platform. So when I set out to kind of develop this process, I put in a 3-prong approach to what we're doing, right? I said, I'm gonna take this company from 0 to 100 million in revenue, and I'm gonna do it without ever taking VC capital. And the first perspective is getting some early, call it friends and family, angels, entrepreneurs, to really support the general vision. And luckily, we're able to do that. One thing I didn't explain, I'm guessing some people on this call, maybe EO or YPO or one of those organizations, Vistage. I've been in EO in New York City for over 14 years. I've been through the EMP program at MIT, and of course have a network of entrepreneurs that get excited about some of the things I've done in my past and some of the things I'll do in the future. And initially, a bunch of entrepreneurs began to invest in the company at anywhere from 50,000 to a couple $100,000. We've been lucky, and I feel grateful that not only have some amazing entrepreneurs invested, but some very influential entrepreneurs have also invested. So some people from my EO group have invested along the way, but also we have a professional hockey player named Jacob Chuva from the New York Rangers. He put some money in. And then even recently in the world of Austin, Justin knows some of these folks, I think, but the founder of HomeAway, a guy named Brian Sharples, who sold HomeAway to Expedia for $4 billion. Obviously, HomeAway is like an Airbnb-like marketplace for homes. He loves the model. He loves what we're doing, and he thinks it could be a multi-billion-dollar company. So he put money in personally, and he also now is an advisor to the company. Then on another person here in Austin is a gentleman by the name of Jason Dorsey that is a global speaker and expert in millennial and Gen Z. And Jason put some money in, and he's also an advisor to the company. He believes that this is going to be a huge driver for millennial and Gen Z world, because it's perfectly set up for the way they want to consume entertainment and the way they want to budget it. Another reason for the concept and why Brian invested. Brian also sits on the board of Ally Financial, which is a millennial bank, publicly traded millennial bank. He sits on the board of GoDaddy. He sits on the board of Yelp. So Brian, he gets some insight into a lot of the way different generations consume content and entertainment. And it's interesting to him, folks like Ally Financial, which is a millennial bank, a lot of the individuals using that, which are mostly, either Gen Z or millennials, tend to budget their money. So as soon as they put their money in the bank, they put X amount of dollars for rent, X amount of dollars for entertainment, X amount of dollars for food. And this is a way that they can actually gamify and budget. So they can budget and pick a $99 a month subscription, and they can say, now I have 100 credits per month. There's thousands of events I can go to. I'm going to maintain my entertainment budget for this month for $100. And I'm going to figure out how I can get the most value out of it. I'm going to check for the deals when there's last minute tickets to a concert that I like, because I know I can use it for X amount of credits. And so the idea is, how many things can I do for the 100 credits I'm allocated per month? And that's just the perfect way that this generation has wanted to participate in this market. Another great investor and advisor is the CEO of Alamo Drafthouse movie theaters. Anybody knows Alamo Drafthouse, Shelley Taylor, she invested and is an advisor to the company as well. And that goes on. There's numerous others. There's some individuals that run venture capital firms that personally put money in. There's a gentleman named Peter Gibson who sold his company to Accenture. He put money in. So collectively, I'm kind of sharing the strategic side, and this is what's available to you guys, is a group of a couple dozen entrepreneurs that put anywhere from $50,000 to $200,000 in to give us the base of operating capital we need to really manage and launch the company. The second form is through the Reg CF crowdfunding. We just recently, about a month ago, launched a crowdfunding campaign through Start Engine. And we're going to utilize that process for two things that are really exciting. One, being a consumer-driven subscription company, we're going to let our members invest in the company. So people can invest in the company for as little as $266. And so they might pay $100 a month to join the company, but they can also be an investor. That gets big down the road when we have hundreds of thousands, not millions of members, that a certain percentage of them, not only will they invest because they can see how exciting and how wonderful the company will be, but they can also participate and likely will be longer members if they're investors. So the lifetime value of a member should increase in direct correlation to those who are part owners of the company. So that's one piece that's exciting. The other thing about using crowdfunding that's exciting is there's an evolution in the crowdfunding world to creating secondary markets for privately held companies. And because so many hundreds of millions of dollars are being raised now through Reg CF and Reg A, there's a burgeoning world of secondary markets. So even on the Start Engine side, 1 year after we start raising, which we started a month ago, anybody that owns shares or units in Festival Pass could choose to sell their shares on the secondary market fostered through Start Engine. And I think by then, within a year, not only will there be a secondary market on Start Engine, but I believe there'll be many other secondary markets, so that when we have tens of thousands of investors, even if they're only at a $2 to $5 to $1,000 investment, it will create enough of a volume so that there is some liquidity for even investors that might have put 100 grand in early and want to cash out because the company's now worth 5 or 10x what it was when they put the money in. So that's something that's pretty interesting to think about. The third piece of the business from a financing perspective that is also super exciting that didn't exist 5 years ago is there's a ton of low-cost debt capital available for direct-to-consumer online companies. One example of those companies is called ClearBank, based out of Toronto. That's just one of a dozen. But what's interesting about it is they'll lend companies like ours or direct-to-consumer companies as much money as we want to utilize towards paid media, because it's easy to track return on ad spend. So if I know for every $100,000 I spend on Facebook ads, I'll get back $500,000 in subscriptions. They then take their debt repayment back on a monthly basis, where it amortizes only a portion of the revenue that's come in. And for us, they lend that money at anywhere from 5 to 15% based upon the fundamentals of the business. And what it does for us is it allows us to have an unlimited access to growth capital without having to raise tens of millions of dollars of venture capital to do so and dilute all of the early shareholders. So if this experiment works out as planned, and so far we're halfway down the road of that process, we didn't reach the revenue goals because events are just coming back now. But if we can maintain operating capital from strategics like the current investors I mentioned and folks like yourself, if we can use the growth capital from the debt financing and not dilute all the individuals that came in early, and any money they put in at the current valuation continues to grow from there. And then if we can use the crowd in order to not only bring in additional capital that can be used at from a unique perspective that might help sustain the business longer because investors want to be part of the company longer, we also create this secondary market. And lastly, on the crowdfunding side, and then I'll be quiet so you guys can ask questions, is that when we raise money through crowdfunding, every few months, we're going to close that and then reopen it at a higher valuation. So what it does is it constantly creates a mark-to-market valuation on a quarterly basis for any investor that had come in early. So if, for example, you guys invested today at X valuation, currently, as we speak right now, we're raising money at a $20 million valuation on Start Engine. By September, we're going to close that and reopen it at a higher valuation based upon the fundamentals of the company. So we'll be, every quarter, it will go from 20 million to 25 or 30 million to 30 or 50 million. And we'll be able to prove that each time we're raising capital on a quarterly basis, the fundamentals of the business have gotten better. And people, hundreds, if not thousands of people, are willing to invest at that new valuation, which secures a mark-to-market for the early investors to know how much their shares are worth. So I'll leave it at that. I know it's a mouthful. I don't know if anybody has questions.
I'll chime in real quick because there's something unique that is happening with this investment where you've opened it up to a $20 million valuation on a crowdfunded site, but because you haven't closed it and therefore sealed that investment at that valuation, you still have this earlier round at a lower valuation, around 11.2 million or something like that, until that happens, which I think is till the end of the month. So I think that that is kind of significant, that you're almost getting in at half valuation of what people are actually investing at right now. But because of the way that it's crowdfunded, it doesn't really count until all the money is in and that round is closed. Is that right, Ed?
That's correct. I think you said it eloquently. And one of the things that we have in our operating agreement is there is anti-dilution. So if we ever raise money at less than you put in, you would be made whole up to that current valuation. So that's something that's important to us. And since on the crowdfund side, since we haven't closed that round won't be closed to what Justin said. It will be a little over a month before we actually close it. But we can still accept money at the valuation of the last round. And the last round was a post 11.2 million valuation. It will be more like 11.5, only because there's been a few $100,000 that have come in since then. And I think you guys all know how that works on a pre and post. But it is a 40% less than the crowd is investing at now. And that's why it's important to me to build the strategic capital with individuals like yourself and the dozen plus that have already invested, and do so in a way where they're getting a better deal prior to us closing.
And what's the max you're taking on this round?
So we're going to take up to $500,000. One of the things we're trying to do is to ensure that we're only taking what we need, and we're only taking the amount that makes, it doesn't dilute any of the early shareholders, right? So we're going to take $500,000 between now and the time we close on the crowdfund round. And then going forward, we're going to utilize mostly crowdfund funds and then debt funds in order to grow the business. Okay, hold on.
Can I ask a quick question? I know there's a couple of questions you're going to answer, but I just was curious. I have a 19-year-old and you're spot on. I mean, she's obsessed. Like if you asked her what she wants to spend her money on, it's concerts, concerts, concerts. And she would love this. But one of the things that I find that she struggles with is that a concert will go on sale and then they start bidding it up and they get priced out. Would a membership in this give them an opportunity to get tickets at better prices? Because I think that would be a huge incentive.
So the answer is yes. A couple of things around that. So one of the promises we make in the process is not paying a ticketing fee. Nobody ever went to Ticketmaster, bought a concert for $100 and paid another 20 on the way out for a fee and said I was happy. So one, it's the perception of blending everything in, so they pay what they know they're paying. But also, as we continue to grow, there's better and better deals we can cut. So there's all these different things, and we look at it as a portfolio approach, right? So there's high demand shows that sometimes it's hard to get a discount for us. But on a portfolio, we can do that. So, we have some relationships where we might be partnering with somebody that's got 100 events or 1,000 events, and 5 of those events are really high demand. We just want an allocation of them so our members can access them, and we might take no margin on that. But on 90% of the events that never sell out, we'll take a 30, 40, 50% margin on being able to push that. So by having it as a portfolio approach with thousands and eventually hundreds of thousands and millions of members, we have that pricing power to be able to move inventory for them and still carry that discount on to our consumers, to our members.
There are a few questions in the chat that you'll want to check out. And I do have personally another call that I'll need to hop to at some point, but I'm going to let this go because you guys might have more questions than what I might be able to stay and host for. But I think you guys
Justin, do you want me to volunteer and be the scapegoat to host?
That'd be awesome, E-Rock. Thank you.
All right.
Yeah, if you open up the chat, you got some good questions here that I think are interesting.
And Ed, it's always good just for the sake of replay to maybe repeat the question just in case people don't see the chat on the replay.
Perfect. So the first question I see is Dinesh. It says, does the company have any subscribers / revenue right now? We do have 45,000 free members. So we started the process. We launched the company right before COVID hit, and then during COVID, we just began to build the infrastructure and the model and the relationships. And then probably 6 months back, we started testing marketing. And one of the things along that line that we've been able to do is on the consumer side, we already have that model down. We know exactly what it costs for us to acquire a member. And I forgot to even talk about our partners. So one of our early investors was a company called Town Square Media, which is the third largest radio group in the country. So they invested $1 million of media and a couple $100,000 in cash. And what that allowed us to do is, even over the last 6 months, we've been testing a lot of that marketing, using radio, using digital, and using social marketing. So the answer is we have 45,000 free members now, a few hundred are paid. But what's going to happen over the next 30, 60 days, we're going to be pulling in data feeds of thousands of major live events. And then that will crank our CRM process to convert those free members into paid. And our projected model is we believe we'll convert 10% of free members into paid over time. So when we talk about acquiring customers, we do a top of the funnel acquisition. And we know as long as we're paying about $5 per free member, and we convert them at 10% of total, we're paying about $50 per acquisition of a paid member, which is less than 1 times recurring revenue. And it's super profitable for us. So that's good. And then the second piece on other partnerships, we just signed a deal with iHeartRadio here in Texas, and we're going to be testing a big campaign with them. But they were willing to do it because they like the brand so much. They were willing to do it on a CPA basis. And most big media companies will never push their media and only be paid if an action happens. So with them, we're only paying $5 per free user they drive. So that's, hopefully that answers that question. How long before you project returns to investors? So in a growth kind of company, it happens in multiple ways. One is, I mentioned the whole secondary market concept. So I'm thinking within 1 to 2 years, there should be enough of a secondary market that investors that are holding units today could go to those markets and sell them. And those will be at multiples much higher than you'd be investing at today. So that's one source of return. The second is in this industry, depending on how fast we grow, we can begin to cash flow. We're not necessarily targeting cash flow to specifically be a classic cash flow model where we will be paying dividends. But that is a possibility depending upon how long we choose not to either sell or choose not to allow people to have a secondary market. And then the third is there's a ton of exit opportunities for us as we grow. And I didn't mention a lot of our other advisors, but I can get into that later. But we have a lot of great advisors, including the former CMO of Live Nation, publicly traded esports company, the head of Coca-Cola North America. So we have a lot of access to some big brands that might be an exit. And we could effectively potentially sell to anyone from iHeartRadio themselves to Live Nation themselves to XM Sirius Satellite Radio, which I know the Corp Dev folks. So there's a lot of opportunity. But to answer your question, is the returns to investors come at a sale of the company or when they choose to sell their shares in a secondary market. How much money is raised in total so far? So there's been about 2 million raised, about $1 million of that cash and another $1 million in media. And there should be, with this 500,000 we're raising, we should also have another 500,000 in the crowdfunded money by around August, September timeframe. So there should be another $1 million coming in that capacity. So hope that answers that question. Any debt on the company balance sheet? To date, 0. But as I mentioned, going forward, we may take on that low cost debt for paid media in order not to dilute the current early investors. And then what is the difference between you and Ticketmaster or StubHub? They are dominant in the market. Great question. So Ticketmaster is owned by Live Nation. They're a traditional ticketing company. And they're everything we're looking to innovate against. They are the big player and dominant player in the market. And they're a classic primary ticketer. So there's about 100 companies like Ticketmaster being the biggest, where they do exclusive deals with venues and entities in order to manage their ticketing. And then they take fees on that ticketing is how they make their money. What we're doing is we're building a consumer community. All of those ticketing companies for decades have never been community driven. It's just been purely transactional, and they don't really have any love in the community. They haven't built any subscription or social or frictionless ways that people can interact. So for us, it's really about building this community where people can come and engage and have a lot of build friendships and have fun. They can know if their friends are going to certain events and build community. And when they become members, they get a lot of value, not only from lower cost tickets, but we're adding a bunch of really cool features over time. By the summer, we'll have a hotel feed, so people can actually get hotels at 30% less than they can on something like hotels.com as a value. And we'll continue to add more and more value. We have a whole social gamification concept with badges and music artists, so people can get special access. We have different partnerships with different venues. So again, over time, people going with their festival pass to certain venues will get a bunch of special privileges. So there's a lot there. It's a much different business model than somebody like a Live Nation. Now on StubHub, one of the concepts of StubHub is there an overall resale marketplace. We actually will be getting a feed very similar to the feed StubHub gets for tickets, but we're going to ensure any of the tickets that we're providing within our environment they meet the model of what we're trying to provide to our member, which is no ticketing fees, a better price, and more value. So there's a lot of ways we're playing and doing that. I have a lot of ticket broker friends that all feed into the StubHub world. And even in the EO, YPO world, there's a couple dozen ticket brokers. So I have good insight into how that whole industry works. And we're going to try a really unique way to still get access and provide those tickets where we can build a better margin by zoning out all the arenas. So instead of getting an actual ticket specific seat, if we zone the arenas, we can convince our consumer that it's just as good at a lower price to get section 103, which is a lower level section of Madison Square Garden, but they won't know the exact seat number until a couple of days before, because we're able to acquire it at a lower price. So that's one example. And as you guys know, in the world of StubHubs and SeatGeek and Vivid Seats, they're all exploding. I know Vivid Seats, I think, is going public in a reverse SPAC for $2 billion. I think you guys know StubHub was bought for $6 billion. So it's a huge industry. We're just doing it differently. And ours is all about recurring revenue, membership, and providing value. And all of that creates so many opportunities for us in the future to have other businesses that come off of what we're currently doing. And again, I can get into some of those other opportunities if there's questions around it.
If you could, so I'll just ask a question, and then if anybody wants to type in the chat or come on audio and share their thoughts or questions. But Ed, in an ideal world, what's the long-term vision if you could have an ideal outcome?
Sure. So ideally, I want to, over the next 18 months, and because all events are coming back in such a huge way, I think it's very possible. I want to make sure we have a few 100,000 paid subscribers here in the US. And then I want to take it to Europe, to Latin America, to Asia, and to Australia. What's so great about the model we have is it's easy to launch under the same tech and under the same structure when all we need is two sides of the marketplace to happen. And the consumer side can always be bought, meaning that as long as you know paid media digitally, you can always acquire customers. And we already have the models to do that. So once we have enough presence in the US or North America, we'll find a partner in Europe probably first and bring it there, and then go country by country or area by area. But ultimately, I just want to grow the business as big as we can get it, as profitably as we can get it. And as long as we're focused on those metrics, all the other opportunities will come along, whether or not it's a sale, whether or not I would love to find a way to go public without going public. And I think that feeds into everything I talked about before about the crowdfunding. Is a couple of years from now, we could easily roll our Reg CF into a Reg A and raise $75 million from the infrastructure we've already built. Because this whole process of crowdfunding, we're collecting the data of these investors as we go forth. And it would be great to be in a situation where we can raise capital whenever we need it at whatever the current market value is, without having to go through the hassle of actually truly being public.
Ben has a question in the chat, if you'd like to address that.
Sure. Are you aware of any other companies trying to do what you are doing to disrupt the industry? So what's interesting is there's no other companies doing specifically what we're doing. Live Nation themselves, about 2 years ago, right before COVID, the summer, I think before COVID, they launched something, they even had the same name, Festival Pass, but they did it in a very similar way that MoviePass tried to do the movies, and it was the wrong business model. And they, without getting into too much detail, they didn't go forward with it. One, because it cannibalized some of their traditional Ticketmaster ticketing, but also they're just not able to be nimble enough to do it. I actually had lunch with a guy named Charles Attal, who is the founder of C3. And if anybody knows Austin, Texas, you know, it was ACL that he created that, and owns a bunch of other venues all over the place. And Live Nation bought his company. And he loves what we're doing. He actually wanted to personally invest, but he actually went back and looked at his contract with Live Nation and didn't let him personally invest. So he's going to be super supportive. He's really good friends with Brian Sharples, who is an investor. So we're going to find some paths there. But what he said to me, he goes, "Love what you're doing. It's super interesting." He goes, Live Nation will buy you if you let them, but they would never be able to create what you're creating. So, you know, good luck, go forth and do it. And what's kind of interesting as well is one of the key factors that make it attractive to rights holders. And Charles is somebody that sits on the right holder side because C3 owns venues, creates festivals. One of the hard part about venue owners and rights holders is they always want to have a full show or a full stadium, or you name it, but they don't always want to admit that it's not sold out. So often what happens is the only path they have to fill seats towards the end of the marketing process is going to places like Groupon tickets, or there's something called Gold Star, where people can get tickets at 30, 40% off. The problem is the second they push tickets into those venues or to those companies, they immediately go on and are searched on Google and show up as 30% off when somebody puts in the name of the event. That's bad, because now the rights holders can't sell that ticket at full price. So what he loved about what we're doing is he can create the ability to distribute tickets to our members as we grow and have a big member base, without ever telling anybody he's discounting them. So he can give them to us for 30, 40% off. We can make them available to our members, and we'll never tell anybody they were a discount. Our members will get value. And because we're converting them into credits, it further obscures what the price of the actual acquisition of that ticket is. And so there's a lot in that rights holder space that people get excited about, because they never really had a way to fill all their seats without admitting that they need to fill the seats.
That sounds like a pretty good, unique advantage. Does anybody else have any questions for Ed while we got him here?
Yeah, Ed, what's the minimum that you're looking for from us? I mean, obviously you want the $500,000 from us, clean it up, done. But what would be the minimum investment?
Sure. So the minimum we've ever taken is $25,000. So it's been a $25,000 minimum, and I think the largest individual investment was $250,000.
And then if, like, let's say I wanted for my daughter to let her go on, she could go on that crowd site. Is it still up there? And she could invest if she wanted to, like,
Sure.
Right?
Yeah, she'd be paying 40% more than you, but.
No. I mean, I just want her to have the experience. Like, I would invest on my end, but I just think it's cool for her to, like, learn how to do it.
Absolutely. The easiest way to do it, she can go to invest.festivalpass.com. And from there, she'll learn about the company and then can click into where the individuals can invest. I think the exact amount is $216 is the minimum. But
and
so far,
and 88 cents, I think.
Okay. Yeah, so the average investment so far, we just launched it, so there's only been about 55,000 invested so far. But what's cool about that too is the process of crowdfunding is exactly the same as consumer marketing. So as we're learning all the analytics about it, we'll slowly start advertising more across Facebook and Instagram to reach a much larger audience. And as long as we can raise money, spending 10 to 20% of the total raised value, it's still much cheaper than it is to go raise venture capital.
I have a question for you that is kind of related, but not directly, is what do you consider the disadvantages in terms of potentially, let's say, bring 1,000 kind of what's called retail investors through the platform versus having to have a small cap table and the communication, the responsibility?
Great question. So the first thing on these current crowdfunding platforms, so Start Engine is the one we're using. It's one line item on the cap table. So every time you launch a raise and close a raise, even if there's 1,000 investors or 2,000 or 10,000 investors, all of those investors go into a LLC that is created by that crowdfunding platform. So
Right.
for us, it's one line item on the cap table. And any communication for K1s or anything else like that is done through the platform. So that's one example. I do have ambitions over the next 12 months to move from utilizing some of those platforms, because while there are some administrative value, there's some disadvantages where I would like our crowdfunding to be handled internally. And there are a number of platforms out there that make that possible. Mm-hmm. And we're going to be moving our cap table probably over the next 6 months to a blockchain-based cap table. There's a company called Bertalo out of Austin that we're going to be leveraging. And as we put our cap table on the blockchain, while it's not necessary, it's helpful. As we go into those secondary market offerings and make our offering available elsewhere, they'll manage the whole back end of the cap table.
Cool. All right.
I've got
I've
got a question. So I don't, you may have covered this or maybe not, but could so since you're doing crowdfunding and potentially going to managing your cap table with blockchain, would it be possible to allow the larger investors to exit and kind of have like liquidation events through your crowdfunding?
Yes. Yeah. So I briefly talked about that a little earlier. Is that
okay? Sorry.
No, absolutely. So one of the benefits is, while it's not that mature of a marketplace today, the new laws that are allowing much more money to be raised through crowdfunding are enabling all of these platforms to create secondary markets. And especially as we move to a self-managed blockchain backend, we can distribute our offering to many, many, many different secondary marketplaces. So I believe within 12 to 24 months or 12 to 18 months, some of these marketplaces will be a lot more active, and we absolutely will be set up to make our shares available on it. Therefore, I do believe that totally different than venture investing where you had a 5 to 7 year hold. I believe that companies like ours will have liquidity access within 12 to 24 months for a lot of our early investors.
But wouldn't you also recommend that, isn't the idea to kind of stay with it? Because if you take your money out, then you don't get to enjoy what's going to happen in 5 to 10 years, right?
Of course. Well, everybody has a different risk horizon when they want capital now or later. So I agree. So if you guys are investing at 11.5, I think it is about now in value, I believe by the end of 2022, we'll be worth a couple $100 million because of the growth. And, if somebody wanted to get out and have a 10, 20x return in a year and a half, then good for them. If they want to stay in and we're worth $1 billion 2 years later, then great. Unicorn.
All right.
I think I want the world of unicorns. I'm going to rephrase that the name as a 4-leaf clover instead of a unicorn, because unicorns don't exist, but 4-leaf clovers exist. They're just very rare.
That's awesome. Are you going to put your contact information in the chat for us?
Yeah, absolutely. I'll go ahead and do that now.
And then while you're doing that, I'll ask Henry's question. What do you see as the biggest risk or challenges to the business?
Sure. Good question. So if I can, is this a trick? If I can type and talk at the same time, then I'm good.
Do you want me to post for you?
That's all right. I got the email there, and I'll put my phone number as well, and then I'll answer the question. So I think the biggest risk, there's two, like any marketplace, you need both sides. You need the consumer side and the inventory side. I'm pretty confident the consumer side is taken care of. We've done enough experimentation that we know as long as we're investing paid media through digital channels, we can grow that consumer to whatever scale level we want. On the inventory side, that is the biggest challenge, but I think we've solved a little bit of that. So as an example, I think I shared a little bit, is within 30 days, maybe 45 at most, we're going to get a feed that's as large as the one that StubHub gets. So we'll get all of the major events that are available. So that should be a big push for us to ensure we have the content and the events that people want to go to. And then all of the other inventory side will be accretive to that. So we'll keep adding different primary ticketers information. So for example, today, we have a partnership with a company called C Tickets. And today we're talking about how to get their content into our system. They mostly are independent music venues throughout the country. So they have hundreds upon hundreds of music venues that are like, the people that put on 200 shows throughout the year, but they're $20 or $30 tickets that a lot of the young people in major cities love to go to. So those are different than the type of tickets that appear on Ticketmaster. So the more and more of that content we can get, the better we can serve the consumer. So I think that's the biggest challenge, is balancing consumer demand and inventory all at the same time. And then I guess the second biggest challenge, this is just pure honesty, is customer service. I saw it when I was at MoviePass going through the process. I saw when there were some challenges to customer service, and it's solvable. It's just one of those things we have to ensure we supply the operational growth in tandem with the membership growth.
Awesome. Well, I know Justin's leaving this running, so I'm going to give like a 6-minute call. And so if we want to take it for the next 6 minutes, just to make sure, because I'm assuming at some point Justin's going to need a Zoom room. What other questions do we have? Have you already had conversations with Justin as far as how, as an aggregate, like, is he trying negotiating any kind of special deal, or this is the special deal that you're just talking from the lower valuation? Yeah,
we haven't had the discussion, and he was just, I think, was happy to kind of let me share it with you guys. And I think part of it was because there is this kind of limited window that will take up to 500 at that 40% discount. That probably, but not probably, it can't ever happen again, because once we close that deal,
there's this 3-letter word that might interfere with that process.
Yes. Does it start with an S and end with a C?
Yeah.
But yeah, so no, he did not mention it in that capacity. I don't know what else we could potentially do. I think part of it is, I think one of your other fellow lifestyle investors who was my classmate at MIT himself is likely investing. And I think that kind of gave Justin the confidence that said, hey, one of our other guys is, he's going to put a certain amount in. And he said, well, I should bring it to everybody because I think they would like this.
If we were able to collectively, so I'm going to do some negotiation on Justin's behalf, and then the worst thing you'll say is no, is if we're able to get to, like, let's say over a certain benchmark, like 400K in funding, would you be opposed to going to a lower minimum dollar amount to open it up to more people to get to the 500K?
Oh, not at all. Again, the threshold of the 25 is really just as you mentioned before, cap table management. So, if the group came in and said, we're going to put in 400 and it's going to be, 40 people or something like that, as long as I can figure out a way to more efficiently handle the documentation and everything, I'd be open to it.
Okay. And I don't want to speak on Justin's behalf, but I'm sure that if we get to that point, we could always do something similar with some sort of SPV or something.
Yeah, I mean, that's if you in other words did it similar to the way
So, right.
Start Engine
Yeah.
does. But
David has a question. Are there competitors in the global markets that already exist? And he's referencing Chorus, Adventus, et cetera.
sure. So there are folks that have tried different variations of just the concept of subscription, but nobody's really done it in the kind of unique way we're approaching it, right? So none of those folks have ever really tried a credit-based currency. And I know as a fact from being deep into it, how beneficial that is to ensuring positive gross margins and unit economics that allow for growth. I've just seen firsthand so many companies fail at subscription because of the inability to understand the costs involved with the product they're offering on subscription. So the credit-based currency solves a lot of that. And then there's some others that have tried kind of remnant inventory. There was a company called Jukely, I think it was called, that worked with a couple very small kind of independent music venues and just tried to, have people pay a subscription. And if random seats were available at the last minute, an hour before the show, they would send some remnant inventory. And, they had a small, passionate group of people that love doing that, but that's not for everybody. So we're looking to actually just change kind of the global market and the way people interact and the way they engage in a community-driven approach to it. So for us, it's much different than any of the other folks that try to jump on.
Awesome question from Hans. Not that any of them weren't, but sorry if I missed this, but what's your moat? What prevents a well-capitalized company coming in and just throwing money at it to crowd you out?
All good questions. I utilize the concept of Airbnb, who came about and they created a pretty good moat. The difference is when you have heterogeneous inventory versus homogeneous inventory. So in a world where a bunch of money just goes in and buys similar product at scale, the thing that's different here, and again, I'm not saying if somebody puts 2 years and hundreds of millions of dollars into it, they couldn't come and learn from everything, I've been building over the last 20 years of my entrepreneurial career and coming to a conclusion to make it work. Is sure they could try it. But the answer is the aggregation of a lot of the inventory, going through multiple deals with dozens of different data feeds in order to get the inventory and to be able to actually build deals with all of these providers is what takes the most amount of time. And similar to what Airbnb had done is once you get to a certain scale where you have all the different inventory and all the deals in place, somebody else would be starting years behind in trying to do that. So if we can get to some level of scale with hundreds of thousands of members in key markets and have all of the good inventory in those key markets, it will prevent others from coming in and just being a me too. Because kind of like the world of streaming as well is if somebody's paying $100 a month to be part of Festival Pass and we have all the good inventory, they're not going to pay another $100 a month to be part of something else to either access the same or less inventory. So we have a moat similar to Airbnb, but I don't ever believe that there's ever a concept of pure barrier to entry.
Awesome. Justin, we saw you flicker on, so I don't know if you want to wrap up this session.
Yeah, I'm going to need to wrap up because I've got another investment opportunity that I'm diving into that Dinesh and I are checking out right now for another really cool, what I think could be a 100x type of company. So we'll see. But you know what, Ed, this has been awesome. I didn't catch the last little bit, but we so appreciate having you on. If you can put your info in the chat. Oh, you did. Perfect. We got you in the chat there. If anyone has questions, definitely dig in with Ed and ask all the questions that you need to ask. But this one is really intriguing to me. So I haven't committed yet to investing, but I am strongly leaning towards it. And so I don't know if you talked about minimums in this group. Did you mention any of that?
I already negotiated a better deal, Justin, if that's okay.
Oh, thanks, E-Rock. What's this deal? I don't even know it.
I think we got them down to maybe like a 10K minimum.
Okay, cool. I like it. Well, I think that this could be fun. I think that you're helping people make it an easier decision. So very good. Well, thank you all for your time, Ed, and everyone who stayed on for, 2.5 hours. This is a good session and a record session of time. So thank you, and we'll talk soon.
Thanks, guys. Appreciate it.
Thanks.